What if you could harness the explosive power of stocks that are already winning? Not by guessing where the market is going, but by simply following the price action. Now this is the Invesco S&P 500 Momentum ETF, ticker symbol SPMO. It's a fund that has delivered exceptional outperformance, but it's often misunderstood. By the end of this video, you'll know exactly how its unique momentum strategy works, why its returns are so explosive, and critically, the specific risks that determine if this fund belongs in your portfolio. Now let's get started. First off, SPMO is managed by Invesco, a global investment leader with $800 billion in AUM, and is known for managing the QQQ and QQQM ETF. Now, SPMO tracks the S&P 500 Momentum Index. Unlike the popular VOO or SPY, its objective is not broad market cap exposure, but it's to capture the excess returns or the alpha associated with the momentum factor. Let's go over the key mechanics on how this ETF finds its winners. Momentum is defined by a stock's price performance over the last 12 months, excluding the most recent month. Now, the exclusion is an important technical nuance because it prevents the fund from reacting to short-term reversal events such as a flash crash. The index then selects around 100 stocks with the best volatility adjusted momentum scores. And this volatility adjustment is critical. It's designed to weed out those highly erratic stocks with huge unpredictable swings, aiming instead for companies that demonstrate more stable, sustained upward trends. And this is a crucial filter that separates SPMO from those other high beta strategies. Now, looking at some of the foundational stats, the fund is highly competitive with an expense ratio of just 13 basis points. And that is a remarkably low fee for a specialized factor fund such as SPMO. Now, this ETF has over $13 billion in assets under management and was incepted back in October of 2015. Now, when you choose to buy SPMO, you are buying the market's hottest stocks at this precise moment. Right now, your top holdings include familiar tech giants with strong financials such as Broadcom, Nvidia, Meta, JP Morgan, Palantir, and some others. Now, SPMO has rules around how the holdings are weighted. The index rules allow a single stock to climb up to a maximum 9% of the fund's total weight during a fund rebalancing. Now, because the index only holds about 100 stocks, the top 10 holdings alone consistently make up over 50% of the entire fund. Now, this high concentration in SPMO is what gives it its speed and its volatility. Now, SPMO's methodology limits any single sector to a 25% weighting during rebalancing periods. Now, as of this video, the sector breakdown is currently heavily weighted in technology at over 30%, financials around 20%, and communication services around 15%. Now, this sector profile is pretty different compared to traditional diversified market indexes such as VOO or SPY. Funds like SPMO make a bold, rules-based bet on the sectors where price movement has been the strongest. So for example, if the momentum factor favored utilities or consumer staples, this chart would flip entirely, showing the strategy's adaptive, dynamic nature. It rebalances semi-annually, once in March and the second in September. This means the list of 100 stocks gets a shakeup twice a year, systematically kicking out the stocks whose momentum has slowed and then adding the new market leaders. This process results in annual portfolio turnover of approximately 44%. This high turnover is what makes momentum momentum. Now for the core thesis, which is performance. Since its inception in 2015, SPMO has generated significant alpha against its broad market benchmark. While the most popular S&P 500 ETF VOO has compounded at about 14.6% annually, SPMO has delivered an average total return of over 17.9% in that same time span. Now that's over 3% of pure momentum premium captured every single year. Now, to give you some perspective, if you invest $10,000 into VOO and SPMO 10 years ago, your VOO investment would be worth roughly $39,000, while your SPMO position would have ballooned to over $50,000. That 3% difference in annual returns can translate to over $10,000 in additional wealth. But as you may know, outperformance comes with a wild ride. Now let's compare SPMO to its biggest competition. Let's look at the iShares MSCI USA Momentum Factor ETF, ticker symbol MTUM. Now, SPMO is slightly cheaper at 13 basis points versus MTUM's 15 basis points. Now, looking at the last 5 years of past performance, SPMO has destroyed MTUM with over 125% returns compared to the 50% returns of MTUM. But looking a bit deeper, the biggest structural differences are in timing and concentration of the funds. MTUM rebalances quarterly, which is 4 times a year, and it maintains more holdings, which is around 125, with a tighter 5% cap compared to SPMO's 9% cap. The higher concentration and less frequent rebalancing of SPMO are often credited for its outperformance over MTUM when mega cap momentum is dominating the market, as the strategy is allowed to ride the winners longer and heavier. Now for the warning signs of SPMO. The single biggest risk is market reversal, so momentum works until the market suddenly flips its sentiment. Because SPMO only rebalances twice a year, a sharp correction will catch it heavily invested in the past winners right before they become the losers. The fund would be unable to react to a sudden crash for up to 6 months, leading to potentially massive and fast losses before the next rebalance can correct the course. So in case that happens one day, you must be prepared for that possibility if you are invested in SPMO. Second, you must accept the high concentration risk. The 9% cap per stock means single stock performance has an enormous impact. If Nvidia or Meta suffers a catastrophic event, the fund will feel it far more acutely than the broader S&P 500. Now, this makes SPMO a fundamentally less diversified large cap fund compared to VOO or VTI. So of course, the big question is, should you buy this fund? SPMO is best for a younger, long-term investor with a high risk tolerance. This should be a smaller position in your portfolio designed specifically to capture the factor premium and amplify long-term growth. Now, I would avoid SPMO if you are nearing retirement, if you rely on income because its dividend is pretty low, or if you know you can't emotionally handle the potential 40 to 50% drawdowns. You need to be patient enough to ride out the inevitable years when momentum underperforms. Now, for my personal opinion, the Invesco S&P 500 Momentum ETF SPMO is one of my absolute favorite, and it's one of my top holdings, and I actually use it as a large position in my portfolio. And the reason I do that is because I am younger, I am more riskier, and I have a long-term time horizon. SPMO is a low-cost, proven factor fund with a historical track record of generating significant alpha. It has superior returns over VOO since inception, which makes it a phenomenal tool for an investor to capture the momentum premium. So now, what are your thoughts on SPMO? Is it too risky for you, or does it fit your appetite? Let me know in the comments below. Don't forget to like and subscribe for the next ETF review, and see you then.